A gold mine sounds like the ultimate business. Dig shiny stuff out of the ground, sell it for thousands an ounce, and get rich. But here's the trap. Before you ever see 1 ounce of profit, you may have to spend 10 to 20 years and hundreds of millions of dollars just proving the gold is worth mining in the first place. And the scale is ridiculous. A troy ounce of gold is only 31.1 grams. At a grade of 1 gram per ton, you need to process about 31 tons of ore to contain 1 ounce before recovery losses. At Livent Goods' reported reserve grade of 0.65 grams per ton, it's about 48 tons of ore per ounce. So the thing you can hold in your hand may require hauling and crushing something closer to a small truckload of rock. Gold is expensive because getting it is a geological argument with a mountain. That's why the real business is not finding gold. It is building a giant rock-moving and chemical processing factory that happens to produce gold. And even getting to that factory is brutal. Exploration alone can take 1 to 10 years. Then comes feasibility studies, permitting, financing, construction, commissioning, and the long list of people who all need to say yes while the clock and the budget keep running. Fewer than 0.1% of prospected sites become productive mines, and only about 10% of discovered gold deposits contain enough economically recoverable gold to justify further development. So the first big lesson is simple. Most money spent on gold never becomes gold production at all. Now let's talk about entry cost, because this is where dreamers usually get humbled. A credible modern industrial gold mine in North America or Australia can easily require about $400 million to $2 billion before meaningful production starts. The 2026 CK Gold feasibility study estimated $394 million of initial capital, plus another $28 million of pre-production owner costs, with $47 million of contingency on top and about $35 million of sustaining capital during the mine's life. Meanwhile, the much larger Livent Goods project estimated $1.93 billion just to build a mine processing 65,000 tons per day. And that is not a typo. That's a billion with a B. Buying an existing mine can skip the exploration headache, but you don't get a discount just because the ore body is already proven. You're paying for reserves, roads, power, processing plants, remaining mine life, and expected future cash flow. In other words, you're buying a money machine that is also slowly running out of ore. So what are you actually selling? Usually not shiny retail gold bars. The mine blasts, hauls, crushes, grinds, and processes ore through methods like gravity separation, flotation, carbon in leach, or heap leaching. Many mines produce doré, which is an impure gold-silver alloy that might be 60% to 90% gold and gets shipped to a refinery. The revenue formula is basically payable gold ounces sold times realized gold price. Sometimes there's silver or copper too. Those byproducts can help a lot, but they're often just credits that make the gold look cheaper to produce. And the gold price is the part you do not control. In June 2026, the LBMA benchmark was about $4,072 per ounce after earlier highs in the year, and the Q1 2026 average was around $4,873. That's a huge swing in a business where many costs are stubbornly fixed. A mine that looks fantastic at $4,000 gold can look merely okay at $2,500 and dangerous near $2,000. The rock doesn't care what the market is doing. Here's the kind of margin that gets investors excited. Suppose the mine produces 100,000 ounces a year and its all-in sustaining cost, or AISC, is $1,700 per ounce. AISC is the industry's attempt to capture the cost of keeping an existing mine running. Mining, processing, maintenance, royalties, taxes, and sustaining capital. It is not the full accounting cost of the business, and it does not magically pay back the original construction bill. At $4,000 gold dollars, revenue is $400 million, and AISC level spending is about $170 million, leaving roughly $230 million at the mine level. At $2,500 gold, revenue is $250 million and the margin falls to about $80 million. At $2,000 gold, revenue is $200 million and the margin is only about $30 million. Still positive? Yes. But that's before debt, corporate overhead, expansion spending, taxes, and the occasional ugly surprise from geology or equipment. And those surprises are expensive, by the way. A mine burns cash in 100 directions. Drilling, blasting, excavating, hauling, waste rock removal, crushing, grinding, electricity, labor, Contractors, maintenance, security, royalties, mining taxes, insurance, ongoing exploration, and eventual closure. A mine can be profitable and still need tens or hundreds of millions a year just to keep producing. That's why working capital matters so much. Construction funding is not enough. You also need contingency money, pre-production payroll, spare parts, stockpiles, commissioning costs, and cash for a slow ramp-up. CK Gold's estimate included $47 million of contingency but excluded $28 million of owner pre-production costs. That's a very polite way of saying the headline number can lie to your face if you don't read the footnotes. And the nightmare scenario is not no gold. It's gold exists, the mine is almost finished, and the financing dies before stable production begins. That is how people end up owning a half-built monument to optimism. Running a mine is also not a solo adventure. You are not the guy with a shovel. You are overseeing geologists, mining engineers, metallurgists, environmental specialists, safety teams, finance people, security, and community or government relations. A blocked permit, flooded pit, failed crusher, or lower than expected grade can turn into millions in lost output very fast. The owner's real job is capital allocation, risk control, and making sure the geological model survives contact with reality. Now for the hidden risks that can wreck the whole thing. Grade risk. The rock contains less gold than expected. Recovery risk. The gold is there, but not economically extractable. Strip ratio risk. You have to remove more waste than planned. Price risk. Gold falls while many costs stay put. Cost inflation. Diesel, steel, labor, explosives, and chemicals all get pricier. Equipment downtime. One crusher or mill can throttle the whole operation. Reserve risk. Resources are not automatically reserved. Permit and political risk. Taxes or royalties change. Community risk. Social approval disappears. Tailings and water risk. Leaks or failures can create huge liabilities. Closure risk. The bill doesn't end when the last ounce is sold. So is this a good investment? Sometimes. Strong feasibility studies often talk about 1.5 to 3 years of payback after commercial production begins. CK Gold projected 2.5 years in its base case and 1.6 years using higher spot prices. But that payback clock starts after the mine has already been found, permitted, financed, and built. It ignores the 10 to 20 years before that, plus the projects that never made it. And big does not automatically mean beautiful. Live & Good estimated $1.93 billion of capital for a 21-year life. Yet at a $1,800 gold assumption, its study showed an NPV of only about $400 million. That is a lot of money to discover that giant mine is not the same thing as great return. The winners usually have higher grades, predictable geology, low waste ratios, existing roads and power, enough financing to survive delays, early high-grade production, useful silver or copper credits, and a plan to replace reserves. The failures lean on optimistic grades, fantasy budgets, heavy debt, and the idea that gold will stay permanently high because hope is a financial strategy now. So the verdict, owning a gold mine can produce hundreds of millions in annual cash flow, but only if you can survive enormous upfront capital, brutal operating complexity, and the fact that the ore body slowly disappears every time you make money. This is not a normal small business investment. It's an institutional scale gamble with geology, politics, and metal prices all sitting at the table. Gold is valuable underground only when you can pull it out for less than the market will pay. Otherwise, it's just a very expensive rock with good branding. Subscribe and tell us what business you want us to cover next.